Okay, we'll call the Audit Committee to order. And we have, as you know, 3 items on the agenda. And the principal one is the 2013 Audit Financial Statements. And welcome. Sherry, you're presenting?
Yes.
Okay.
So I'm pleased to be here today to present the 2013 Annual Financial Report to the Audit Committee. I will be providing a bit of context to the consolidated financial statements and will present a few slides that provide a high-level overview of the city's financial condition. Then KPMG will present the findings of their audit. As in the past, Mr. Matt Beddick will present, but Mr. Tom Mennel and Brendan Hall are in attendance as well from KPMG. As Audit Committee is aware, the city's accounting staff prepare the city's consolidated financial statements in accordance with Canadian Generally Accepted Accounting Principle as established by the Public Sector Accounting Board. I will not be running through the year-over-year and actual-to-budget variances for the 2013 consolidated financial results, as the explanations for significant variances have been included in the financial statement discussion and analysis section of the annual report. This starts at page 17 in the color section of your handouts today. Instead, I'll explain what is included in the statements and what is different from the December 31st, 2013 tax-based operating and enterprise results for the city, which you already had the opportunity to review in March of this year. The consolidated financial statements combine the results of the tax-based operations, enterprises, local boards, capital activity, and reserve fund activity. They also account for the 2 government business enterprises, Kitchener Power Corp, referred to as KPC, and Kitchener Generation Corporation, referred to as KGC, and this is the solar roof on top of the Kitchener Operations Facility. Local boards include the Centre in the Square, Inc., Kitchener Public Library, Belmont Improvement Area, and the Kitchener Downtown Improvement Area. And this slide is a little hard to see, but hopefully in your handouts it is a little bit easier to read. One of the largest differences you see in the consolidated statements when compared to the tax base and enterprise statements is the annual and accumulated surplus figures. We thought it would be helpful to walk Council through the difference in the annual surplus on the statement of operations in the consolidated financial statements, approximately $44 million, compared to the operating results that were presented by the Financial Planning Division in March for the same time frame, and that was just under $15 million. As mentioned earlier in this presentation, the consolidated financial statements include the results of the tax-based operations, the enterprises, the reserve fund activity, capital activity, and the activity of the local boards, plus the effects of the government business enterprises. Further adjustments are then made to these results to have them reported in line with the Canadian Institute of Chartered Accountants Public Sector Accounting Board standards. The largest adjustments required to comply with PSAB include capitalizing our tangible capital assets on the balance sheet and amortizing them over the life of the asset. The statement of operation recognizes the revenue streams that were used to fund the creation of assets, with the exception of debt proceeds. However, the capital expenditures on tangible capital assets are excluded, as they will be expensed over the useful life of those assets. We are required to remove debt proceeds and principal repayments from the income statement, as the debt is accounted for on the balance sheet. Interest paid on existing debt, however, is recorded as an expense in the income statement. There are other adjustments required, but these have a much smaller impact. So, what does this mean? The accumulated surplus of $1.1 billion on the consolidated statement of financial position is not a surplus as you'd be used to hearing of in regards to operating results. These are not dollars available to be spent. They are a representation of past investments that the city has made that continue to provide benefit to the city going forward. Things like tangible capital assets, investments in Kitchener Generation Corporation and Kitchener Power Corp, and reserves set aside for specific purposes. In the previous slides, we saw that the largest impacts on surplus are those related to tangible capital assets. In the past 5 years since TCA have been reported in the city's financial statements, the net book value, which is cost less the accumulated amortization applied, has continued to experience modest growth. Each year, the net acquisitions, or assets less disposals, has exceeded the amortization expense applied in that year. The net book value as a percentage of cost has remained steady at around 68%. If this percentage were dropping significantly, it would indicate that our asset renewal programs were in serious trouble. The next few slides will present the financial condition of the city. Financial condition speaks to the city's ability to finance its operations on an ongoing basis, despite economic changes and changes in other environmental factors such as growth within the city. This chart shows the 5-year trend in the overall debt balances for the city, broken down between the various purposes of the debt. In line with the EDIF plan, the overall debt burden increased in 2013, but only slightly. This is the last year of the EDIF program, so going forward, no additional EDIF debentures will be issued, and that portion of the debt will start to decline and be eliminated over the next 15 years. This chart here shows the 5-year trend in the consolidated reserve balances. As can be seen in the graph, 2010 was the low year at $22 million, but balances have been increasing over the last 3 years. Council passed a consolidated reserve policy in 2012, which provides a framework for building up reserve balances and ensuring they are used as intended. The next couple of slides will provide a bit more detail about the various types of reserve and their balances compared to their target levels. One of the components of the reserve fund policy was categories for improved reporting. The 5 categories shown on this slide were used during budget discussions, and the next slide will show 2013 closing balances by these categories. So this chart is split into 3 sections. The top section shows the 2013 ending balances for reserves. The middle section shows the target ranges for the reserve categories and how well the reserves meet the minimum target. The bottom section shows the 2012 ending balances for reserves and the change between the current year and 2012. I will draw your attention to the far right total column. Here you can see that total ending reserve balances in 2013 were nearly $48 million, which is 71% of the minimum target balance of $67 million, and is up from $41 million at the end of 2012. So although there is improvement overall, the city is far from being in line with even its minimum target reserve balance. Great strides were made in improving capital reserves, but there has been a continued draw on the already strapped stabilization reserves, which exposes the city to financial risk factors such as weather volatility. I wanted to note one change to this slide. In the comparator chart at the right, I accidentally put in Kitchener's 2013 ratio, whereby the chart is for 2012, so the 3.00 at the bottom should read 3.20.
3.20?
3.20, yes. This graph combines the city debt and reserve positions together. Rating agencies consider a debt-to-reserve ratio of 1:1 to be financially prudent, which means the city would have $1 in reserve for every dollar in debt. It can be seen in the chart to the right that the listed comparator municipalities all hold more in reserves than they do in debt, with the exception of the city of Waterloo. The city's ratio is more than 2 times that of Waterloo and is 10 times that of Cambridge. At the end of 2013, the city has $3 in debt for every dollar in reserve. This shows some improvement from 2012's ratio of 3.2. The magnitude of the city's debt load can largely be attributed to EDIF and was known before the approval of that 10-year program. The final financial measure to be presented today is also the most complete picture of the city's financial health. Financial position per capita is determined by subtracting total liabilities from the total financial assets and then dividing by population. This measure shows if the city has enough cash and investments available to pay everything it owes to others, including its municipal debt. The value of $705 in 2012 is positive, which means that Kitchener does have more than enough on hand to pay off all of its creditors. It is also close to both the average and median of this sample. So Kitchener is in line to those here that we have as comparative municipalities. Finally, as shown in the graph, Kitchener has kept a fairly steady position over the last 5 years, which shows that even though debt levels have been rising, the city is not in financial peril. The city will want to continue to maintain the strong financial position. The next slide contains recommendations as to how to achieve this. Council is encouraged to limit new debt to that already planned for in the 10-year capital forecast and allow debt levels to fall as the EDIF debt matures. Continue to build reserve balances. This means resisting the urge to draw on existing balances for uses other than what the reserves were created for. Continue to hold long-term investments like the hydro utility, which provide investment income and cash flows year over year. So with the exception of any questions, I will turn it over to KPMG.
Okay, there are some questions. First one that popped up was Cynthia's position. Do you have your button must have been pushed accidentally? Okay. Councilor Fernandez.
Thank you, Sherry. When you were just talking about our financial position, and you said that our debt to reserve ratio was a 3-to-1, but then you went on to say that compared to our municipal comparators, that we were in a better position because of our assets. And correct me if I'm wrong, because maybe I didn't hear you correctly. Would that be our shares in Kitchener Power and our gas utility?
I wouldn't have referred to our assets in reference to the debt to reserve ratio. I was saying that we were 2 times higher, which is a negative, than the City of Waterloo, and 10 times higher than the City of Cambridge.
Okay.
Higher in this ratio is a negative.
Right.
Higher debt.
Yep, higher debt. Okay. I thought I heard you say something with relation to we would be in a better position. We're in a better position because of our assets. I don't know where.
I think that was in relationship to the next slide, the financial position per capita, I think.
Yeah, that could have been this. Yeah, it could have been that one.
In that case, we are right in line with the average and the median in the comparative municipalities. So we do want to ensure that we hold on to those larger assets and investments to continue to provide the benefits going forward.
Okay, so that I have it completely, that I'm clear, the assets that I'm speaking about, so that's our Kitchener utilities and our hydro, our holdings in hydro, those offset or make our financial position per capita better than our comparators.
It's a number of things. Mr. Chapman, you want to add something?
Through the chair, to agree with that comment, yes, but really it is our investment in Kitchener Power Corporation that makes the most substantial difference, because that is reported as an investment on our balance sheet. Because the gas utility is a division and operation of the city, it does not have the same impact on financial position. So unlike Waterloo, which has monetized a part of their investment, Cambridge the same, we've continued to hold our entire investment in Kitchener Power Corporation, and that's one of the major factors in our strong financial position.
Okay, and that's exactly where I was alluding to. So if we didn't, as long as we have that, it's considered an asset. But once we sell that, then of course we'll have the funds to reduce our debt. Is that?
Once we sell it.
If we were to sell it? If, big word,
Do
if,
you know
not
something
once,
we
if.
don't
No, I just, hypothetical question.
At the time of a sale, the asset that's on the investments would convert into cash, which is also an investment, but as soon as that cash is used, that line goes away from the balance sheet. So as long as it's there, it can't be spent, in which case then we have the strong financial position as the assets over the debt.
Okay, I'm just trying to get sort of a very basic understanding. It was just a hypothetical question, hypothetical situation. I don't know anything.
Okay. Councillor Glenn Graham.
Thanks very much. Sherry, I just wanted to ask about the book value, and on page 1-28, you talked about the net book value. We have a 68%. And what is the value that we would be in trouble at? You talked about the threshold there. Where would that be?
Given the assets are different in every municipality, there isn't a set number that would be indicative of a problem. What I did mention was that if that percentage that we are at, and currently we've been at around the 68% for the last 5 years, if it started to decline quickly, that would mean that we're not replacing our assets as quickly as we're using them up. So it is something that you want to kind of keep an eye on, our trend versus the actual ratio.
Could you explain what you mean by replacing our assets?
So as a road, for example, gets used and deteriorates, it would need to be replaced and maintained. So those types of things, community centers, once they get past their useful life and they become not usable anymore, those are things that we have to go out and replace.
Okay, great. Is there a top end that is an ideal, or, I mean, I don't know where we are in terms of other municipalities, so I guess I'm just trying to find out what the context is.
And tangible capital assets is hard to do a pure comparison to other municipalities because the mix of assets are always going to be slightly different. The useful life is something that's decided on in each individual municipality. So for example, if we were to use 20 years on the surface of our road and Cambridge was to use 50 years, that ratio would significantly differ between the two, but it's something that you want to watch your internal trends more than necessarily doing comparison to others, just because there's so many variables that play into that it doesn't give an apples to apples comparison.
Thank you very much.
Councillor Davey.
Thank you. Just wanted to make sure I understood correctly on page 132, the reserve funds. We've been building in each year, we've been adding to the reserves. So back in 2010, it was 22 million, and through successive budgets, we've gone up to 37. And we're still below the reserve, but I know it's not an apples to apples comparison because on 2 pages later, it says that there's 47 million that are accounted for in different ways. But how does that 47 million figure, do we know offhand how that relates, how that has the extra 10 million has changed in the last 4 years, or can I just think of it as linear? The 47 compared to the 37 compared to the 22?
We have always been removing the same items, but off the top of my head, I don't have the dollar values for the adjustments between the consolidated statements and the reserves as reported in this format. I could get that information for you if you so desired.
It would be interesting to see how much that affects the growth we've seen in our general reserves. My other question is more of a confirmation type question, but in the summary of retaining a strong financial position, while the charts paint sort of a bleak picture somewhat in terms of debt ending in 2013, the suggestion, or to preserve the city's financial position, it says that we need to reduce debt. Now, to clarify, there's no necessary action that council needs because EDIF has been fully funded on a go-forward basis. There's no specific budgetary action going forward we need to enact to reduce debt. It's more I think, I guess what I'm saying is this should say, don't take on further debt. Is that a fair thing to say instead of reducing debt?
Yes, I wanted to not say don't take on further debt because there is some debt built into the 10-year capital forecast. But yes, as EDIF matures, that debt will fall off. And on the slide, it does tell us what the debt to reserve ratio would be if we were to remove EDIF and the enterprise debt. And then we're at 0.6.
Very good. Thank you.
Next question, Councillor Singh.
Yes, thank you, Mayor Zaire. And Karina, thank you for the report. Just quickly comparing our fiscal and financial position, when looking at our reserve values, increasing from 22 million and starting 2010 and now end of 2013, we're looking at 47 million. I'm guessing the reserves have increased based on council direction, and they've been built into our base budgets in the previous consecutive years, correct?
I would say on the capital front, that is the case. Those ones have been increasing, but the stabilization reserves have been continuing to decline.
So at the same time, with ways to further strengthen our reserves, our reserve accounts, that can be done through, of course, increasing through the tax base, as well as additional efficiencies in the corporation, where year-end balances are more favorable, which continues to strengthen our reserves. So the fact that since 2010, for our tax increases, they have been consecutively lower from the previous year over the last 4 years, and the fact that our reserves have been going up, that shows strong financial strength. Is that fair to stipulate it that way, or am I overstating the fact?
Mr. Chapman would like to add something?
To clarify a point and then respond to that question, I wouldn't say the balances have grown because we've added budget lines to fund reserves. I can't think of examples where we have increased the allotments to reserves. I think it's been more a reflection of council's discipline. So development charges is a good example where we've had to defer projects, manage the capital program to remove the deficit from that reserve. So I think council has been disciplined in the use of its reserve policy to ensure that the funds are carefully managed and they're used only for the intended purpose. And so we've seen the benefit of that over the past 3 years.
Right. So and I wanted to reiterate that very point. So that's good. And the last question, Karina, so obviously you looked at the financial position per capita. That's looking at our overall assets. That's entire assets of the corporation, and that's streets as well. At the end of the day, we're not going to go about and start selling the streets off. If you look at our tangible assets that are a little bit more liquid, and they have been referred by previous members as well, speaking to our gas utility, speaking to our hydro, our Guelph enterprise, even our parking enterprise. These are more sellable, tangible assets, but their asset valuation is still well beyond what our overall debt is, correct?
The financial position per capita actually removes tangible capital assets from the ratio. It's only the current assets divided by our total debt. So the tangible assets, such as the roads, are not, in fact, included in that ratio. These are more the liquid assets.
So the liquid assets do show that considerable financial strength then. Okay, that's good. All right, perfect. Thank you.
Councillor Yanetsky.
Thank you. On page 126 of your report, Understanding Surplus, when I'm looking at the bottom category, the revenues not included in the operating surplus. This is sort of a nice number of figures of 37 million that seems to be generated from different sources, but yet it somehow gives me the impression that it's misleading, and you can maybe comment on it, that using the first one, development charges 6.6 million, but yet we seem to be in the hole, and it's not reflected elsewhere through this. How does this all equate?
These are solely revenues, so this relates to revenue sources that are earned through primarily the capital funding model. So we would go out, we would get debt, which doesn't get included because of PSAB purposes, but things like development charges go into our capital, as do capital grants from other levels of government. So these are truly reflecting just the revenues. This is not a net number of the revenues less the expenses. The development charges are in fact in a deficit position, but there's plans to fund that.
Okay, so having answered that, then the other 2-3 categories, capital grants, investment income, donated assets, are those truly reflective, or is there some type of component of operating that would also reduce this to make it a different ultimate figure, a net figure?
These are truly capital-related items, so there's nothing in operating that is impacting these numbers. I'm
Not
not
like
sure I'm
development
understanding the
charges.
question.
Not
Sorry?
like development charges. Development charges got a revenue portion, but it's also got an operating portion where it's in the hole in the end. But you're only showing what the revenue is here. That's all.
Yes, for this reconciling from surplus from from the operating results to the capital, we only have to pull out the revenue side here.
Okay. Moving up into the next middle category on the same page, consolidation, you get the public library, center and square, and et cetera, et cetera. Where does the farmer's market fit in this?
The farmers market is within the core city operations, so it would be just within the operating results, and you would have seen them in the results presented in March.
So it wouldn't be separate because it doesn't have a separate board or anything like that?
That's correct.
And so the auditorium would be in the same situation? Correct. No separate board? Okay.
Back to Councillor Singh.
Yeah, Sherry, in my focus of asking the question, my apologies, I called you Karina. So I'll leave it amongst you two to figure out if that was an insult or a compliment, but my apologies.
Okay, just a couple of observations or questions. On the debt to reserve ratio, if we would go to 1-31, and if you put the debt to reserve ratios beside each of those bars for 2013, it would be 1.78, 0.65, I think it is, and 0.6 for a total of 3.02, not 3.20. I might have wrote the number down wrong. 3.02.
These have, I noticed that today. These have all been rounded to one decimal place, but the zeros have lingered in, so I should have removed the 0. It's technically, 2013 is 3.02. 2012 is what's in the side comparative, which is 3.2.
That's fine. So, and the enterprise is composed of a number of things. Partly the, well, no, I'm sorry. It's the auditorium related to the Rangers for a significant portion of it. But how much is in there, if any, related to gas enterprise?
There is no debt related to gas.
And through to water and sewer, 0 as well?
Water and sewer is 0 as well.
So
the parking enterprise and golf would have small amounts in there. Okay.
So to remove those, I'm just looking to see, it would come to, if you exclude enterprises, 2.38. Just trying to give that perspective. But it was, as you've said at the outset, it was part of the plan. Okay, there are no other questions on that presentation. Where do we go next?
So Matt Beddick will be coming up now to present the findings of their audit.
Okay. Welcome, Matt.
Thank you. Is our presentation up here? No, it's not. No, that's okay. No problem. I have the copy of the agenda materials, so I can refer to it by the pages in the agenda materials.
Okay.
Okay. So thank you, members of the Audit Committee, for hearing us today. Our report starts on page 1-4 in your materials, and I'll hit the highlights of our report as we go through. If there are any questions as I'm going along, I'd be happy to take them, but I'll also take time at the end for questions. So on page 1-6 is our executive summary. With respect to the report, we are in a position to issue our auditor's report on the consolidated financial statements of the city. A copy of that report is included in Appendix 1 to your agenda materials, which is on 1-14. That audit report is a clean auditor's report with no modifications or any other items in there, so that is what you want. That will be done once the discussion here is completed and the financial statements have been approved.
On pages 1-7 to 1-9, we go through some other matters that we've identified during the course of our audit. These are not unresolved, but things that we thought were important for the committee's attention in evaluating the financial statements, and things to watch on a go-forward basis from here. First item I'll bring to your attention is with respect to the stormwater management fee rebate accrual. As you will be aware, when the utility was introduced several years ago, there was a rebate program that was introduced nearly at the same time to allow residents to get a rebate on some of their fees based on activities that were happening on their properties. When the program was originally introduced, there was some uncertainty as to how much the take-up on that program was going to be. And in the first couple of years, there were accruals that were built based on information and experience at other municipalities, as well as the provisions of that rebate program. In 2013, the accrual has been reduced down to about $100,000, which recognizes the fact that the program isn't largely used within the city. There haven't been a lot of claims necessarily to date. As well, there's no retroactivity within the program. So a resident cannot come back and claim a rebate for 2011 or 2012. There's a time limit on that. So we are satisfied with the accrual level down to $100,000. We believe that the process undertaken by staff to determine that was the appropriate one under the circumstances. But we do encourage them to continue to use the city's own experience in setting the accrual each year after this. On to page 1-8, and staying with the theme of the stormwater management utility, we do know that the utility fees were assessed against properties that were owned by school boards, and there's been some discussion about that I'm sure council is aware. While the city has continued to assess the fees against the school boards, it has also provided an equal and offsetting grant to those organizations such that the net revenue and the net asset with respect to stormwater management fees remains at zero. They've continued to do this for record-keeping purposes, and should this be clarified in the future such that the city can properly assess those charges against the school boards, the history is there and intact. We concur with management's position based on its action so far not to record any net revenue or any net assets with respect to the stormwater fee for school boards. On page 1-9, we highlight a few items with respect to the accounting for tangible capital assets, and I know Sherry spent some time talking about that. We have to reiterate that this is a complex accounting standard to apply, especially in the nature of a city whereby you've got large capital projects, you've got small capital projects, you've got significant repairs and maintenance activities as well, and sometimes it's a little bit difficult to discern between what is a capital project versus a maintenance project. So during 2013, there were two items that were identified, both the Schneider Creek and the Grand River erosion control, of items that were originally treated as capital, but it was noted during the closeout of those projects that they were in fact maintenance, and they didn't meet the test of a tangible capital asset under the standard. And as such, those amounts were adjusted in fiscal 13, and those expenses recorded in the financial statements in fiscal 13. Page 1-10, we just talk a little bit about significant qualitative aspects of the financial statements. There have been no new accounting policies or significant accounting policies adopted in the financial statements. Much of the notes are fairly the same as they were in the previous years, only updating the figures to reflect the current year's results and activity. With respect to estimates, there are two major sources of estimates within the financial statements. That is the estimate of useful lives of those assets, as Sherry had related to, whether it's a 20-year or 30-year or 40-year life, as well as some of the assumptions that are included in the actuarial results on the employee future benefits and the WSIB benefits that are provided to employees. The second last thing I'll talk about is with respect to audit differences. In the course of our audit, there were no corrections that we were requiring to be made to these financial statements. So these are the accounts that were prepared in advance of the start of the audit, which is good news. And any audit differences which were clearly insignificant, we've agreed that they're not material to those financial statements. Lastly, in the appendices to our report on page 1-16, We present our annual independence letter. This is a required communication from auditors to our clients stating that we remain independent of the city in our work. Therefore, we're able to fulfill our role as financial statement auditors. We also list out the additional services that we do provide to allow you, the committee, to also evaluate that independence. So that concludes our formal remarks, but as usual, we'll be happy to take any questions.
Okay. Councillor Gazzola.
I don't have a question of our auditors. I have a question of staff that I've just...
Okay, why don't you ask it now?
Yeah, it's to do with the stormwater management fees and the school boards. What is the amount of money that we're talking about, roughly?
Sherry, do you have that?
I don't recall the figure off the top of my head. Can you think of
Okay,
it,
it's
Dan?
not an urgent matter. Something I'm just curious as to. The important thing is that I wanted to ask. We seem to have been losing our battle on this. Is there any? Do we have any rights of appealing to somebody on this, or to some government, or what?
Perhaps I can speak to that because it has been a more than a bureaucratic decision. It was a political decision that came down from the ministers, and effectively from cabinet, because it crossed some ministerial boundaries. And the argument, as we all know, was the Municipal Act allowed us to charge it, and the Education Act was being interpreted that the school board did not have to pay it. And the final directive came from the province that we would not be able to collect on it. We would, but we could, and as was explained, there could be some change in the future, but not to lose track of the amount. It is being billed, but then a net zero based on that authorized, or that determination by the province that we would not be able to collect it, nets out to zero. So at this point in time, there is no appeal process. Would that process be changed in the future? That's probably, your guess is as good as mine. As staff have told us a couple of times from the utility side, saying that there are other municipalities across the province who are looking at this very same thing, and that kind of pressure will build up. And I would suggest in some time in the future years, it will come back to a provincial decision related to the, again, whether or not the school boards will need to pay for it. I don't know if there's any staff that want to add to that. Don't think so. Does that answer the question?
That's not the answer I wanted to hear, but it does answer. Thank you.
Councillor Fernandez.
Thank you. When you review our financial statements, is there an example of a red flag that you might be looking for, or and how would you present that to council?
Okay. There are lots of red flags that we're looking for. In each line item in the financial statements, we're looking to obtain evidence that supports whether or not that item is properly recorded. So, for example, at a very basic level, the cash balances, we're going to look at the bank statements. And there's some reconciling items, outstanding checks and the like. We're going to see that those line up. We may find an issue where there are unusual reconciling items that we cannot find appropriate support for. If that was this case, we would bring that forward. We may look in the areas of accrued liabilities. So these are estimates of payments to be made in the future. And we'd look at what evidence supports those. Sometimes there's better evidence depending on the nature of the accrual. Sometimes there's worse evidence, or there's limited evidence based on how much judgment's included in it. If we're seeing there's not sufficient support for an accrual that's recorded, either too high or too low, then that may be another item that we would bring forward to committee.
Okay,
Is
thank
that
you.
those two good examples?
Yeah, those are great. Thank you very much. So we just heard about what our debt to reserve ratio is.
Sure.
And is that something you look at as well when you're looking at our financial statements? And would you be able to comment on that?
Not specifically, because again, we're looking to verify the amounts that are recorded in the financial statements. And when it comes to reserves, those comprise a component of the accumulated surplus. So in fact, we don't really distinguish between reserves and just general surplus in the work that we perform there. If the level of debt to surplus or level of debt to assets, the financial position that Sherry referred to, got to be very bad or even bad, that would raise an accounting concern around the city's ability to make good on its debts. And I don't want to say the word too loud. That's what happened in Detroit. Okay, that's when the auditors would get involved in that, because then there's concerns about whether the organization has the ability to repay its debts. Certainly we look at that, but the financial position as outlined by Sherry and confirmed by Councillor Singh shows that there's sufficient assets to meet those obligations.
Okay, thank you very much.
You're welcome.
Okay, I don't see any other questions or comments. Thank you, Matt. Do you want to add something?
In closing, we'd like to thank Dan and the rest of the finance team, Roger, Brenda, Sherry, and even Becky up there, for the work that they've done through the audit. We couldn't do our job if they weren't well prepared, and it's sort of a collaborative effort that works together, so thank you for that.
Thank you very much. So if the committee will go back to 1-1. There is a recommendation there. Someone prepared to move that? Councillor Ioannidis, seconded by Councillor Singh. Those in favour? Opposed? That is carried unanimously. Question for, and I should know this, well, maybe I could even find it, but is that on tonight's council meeting for ratification, or does that come back in August? Someone know? Does it need to be added to tonight's agenda for council? Mr. Chapman.
Through the chair, you've heard today that to issue their unqualified audit report, they require formal approval, so I think it would be most appropriate if it can be added to ratify it at council. If not, I think council's intent is clear. So procedurally, I can talk to Christine about having that added to the agenda this evening.
If you could. Councillor Etherington on the subject of the financial statements?
No, I did not.
Okay. Okay. We'll now move to item number 2, which is the second quarter audit status report. Karina, thank you, folks, for coming in.
All right, good afternoon, everyone. Just wait for my presentation to get up on the screen there. There we go. All right, so I'll be presenting 2 things to you this afternoon. The first will be my second quarter audit status report, followed by an update on risk management. So in the second quarter status report, there are 2 audits that I have completed over the last quarter. The first being a capacity review of the Kitchener market, and the second being a controls audit of our cash deposit process. Also in progress right now is the comprehensive review of our purchasing division. So I'll talk about the market first. The objective of this review was to analyze the work volumes and determine what the optimal staffing level was. And this was in response to a lot of high turnover, a lot of overtime, unpaid overtime being worked in the division, a lot of stress of the employees. So it was really to come in and confirm, do they need more staff or not? So the methodology was a standard one that I do in capacity reviews. I start with an interview of the staff to find out what they do on a day-to-day basis. Where are their pain points? Where do they feel there are inefficiencies or areas that could be improved? Then I ask staff to track their time down to the minute for a period of 1 month so that I could get a very fulsome idea of what it is they do on a day-to-day basis, and categorize those into different task buckets. I was also able to glean from that information how much unpaid overtime they're actually working on an average basis, whether they're taking their lunch breaks, whether they're taking their other breaks as well. So this is what their current situation is. In terms of their staffing, they have 4 full-time staff, and that includes the manager, 2 office staff, and 1 custodian. They also have 13 part-time staff, which mostly work on the market floor and the custodial and maintenance positions on the Saturday markets. This staffing complement not only supports the Saturday market and crafter vendors, but also the International Food Court, which operates from Tuesday to Saturday, the Marketplace, which is the rental venue, which is for cooking classes and other programs that operates year-round, and it is also can be rented out similar to a community center for community events. So when I looked at the capacity data that came out of them tracking their time for a month, I found that the full-time staff are not taking their breaks and lunches. These are, except for the management position, these are union positions, which they should be getting an hour lunch and 2 15-minute breaks. So this is in contravention to the collective agreement. On average, those full-time staff, the unpaid overtime equates to 6.7 hours in total. So that's almost equivalent to 1 full-time FTE. I also discovered through this that they have a very large breadth of tasks requiring many different skills. So there's a lot of small things that they're doing throughout their days. A lot of the strategic level tasks that the manager and the program coordinator should be doing don't have as much focus as they should have. So there's not enough time to do the strategic planning, some of the sales and marketing type work. They're focusing on helping out the administrative staff, do the things like rent collection, doing up the contracts for the vendors, those types of day-to-day things that really they shouldn't be focusing their time on. We also found that there has been some lost revenue opportunities. So they don't have enough staff to handle Sunday bookings. They've had to turn down some of the Sunday bookings in the marketplace. So the main recommendation coming out of this review is that we need another part-time program assistant, so that's the administrative position. And the benefits of providing such a position is that we're going to alleviate some of that workload on the other 3 office positions. It'll allow them to take their breaks and their lunches, and that includes having coverage in the office over the lunch hour. They always need to have someone there to answer the phone and handle the window where either vendors or customers are coming up with questions or complaints. We're hoping that this action will then help reduce turnover. So we've had a significant turnover in those positions, which adds to the stress because you're constantly retraining staff and you're short-staffed in that gapping period in between when you're trying to hire. This will also allow the manager and the program coordinator to focus more on the strategic tasks related to their jobs, and will provide us with some flexibility to staff Sunday events. Some other recommendations that came out of the interview process, there are some opportunities to discuss 2 things with the unions. First off, right now, one of the part-time positions is helping out in the office. And because they are a Series 9000 employee, they are not allowed under the jurisdiction of the other collective agreements to input anything into class. So if someone calls up with a program registration, they have to write it on paper and hand it to one of the other staff to actually put it into the system. So that is a discussion point that we'd like to have with the unions. It has been done at the community centers, and they have agreed to that concession there. The second one is with the maintenance items. So we have market staff who are looking after the market and are not allowed to do any of the maintenance items, minor maintenance items. So they have to call FM, get a work order set up, which the manager has to input, and wait in the queue to have these things done. So we're suggesting that all 3 groups, so the union, the market, and FM, should have a discussion on what could be done on a minor maintenance level that would save having to have FM come out to do those things. And this was articulated through FM as well as something that they would be open to. The next was to articulate purpose and vision. So as you're well aware, there is a perception that the market should be making money and should be making a profit, but we see it as getting a subsidy from the city. So really it's about senior management and council articulating what that vision and purpose is for the market so that everyone's aware, and that will help to determine how funds are spent in the future in terms of, do we spend more money on marketing, do we spend more money on maintenance, and so forth. And the final one is the developing a maintenance strategy. There's a little bit of ambiguity in this regard. So we've got 3 entities in there right now. We've got the market staff, we've got the parking enterprise, who handle the parking garage, as well as FM. And it's sometimes unclear as to who is responsible for planning the maintenance and planning the capital upgrades. So we really need to get those 3 groups to the table to set out what the roles and responsibilities are regarding maintenance. So in conclusion, really the main finding out of this is that something needs to be done. We need to stop the turnover, stop the high stress due to the workload, particularly in the office. And the data really supports that need for more staff. I am suggesting, as I said, the data concludes that it's almost 1 full FTE. I'm suggesting just putting in a part-time to see if this alleviates some of the workload, and monitor it going forward. We may need to then look to further process improvements, which at this point I'm not seeing any real opportunities. The processes that they are using are very standard things like payroll and scheduling and SAP, those things. There's not a lot of opportunity for improvements there, but it is something that they could look at, in addition to service level reductions if we need to go down that route. So are there any questions on that audit?
There are a few. Councillor Fernandez.
Thank you, Karina. Just a couple questions related. You talked about lost revenue opportunities for Sunday bookings. Is there any way we can have an understanding of what those revenues would have been if we had been able to capture them?
I can ask the market to articulate that to me.
Yeah, because I think that's important for us to understand if we're going to put another staff person in place. I think that it needs to be not only alleviating some of the stress from the rest of the staff, but also hopefully capturing that additional possibility for revenue. I don't know how to articulate this without sounding disappointed, I guess. I thought we had resolved that whole issue with the 900 series. I'm completely mystified why we have somebody have such an inefficient process. I understand it's a union issue, but I guess it's just, I think common sense should prevail.
Yeah, to my understanding, the agreement only applied to the community center employees. So when I talked to labor relations, they said another discussion would need to take place to make it apply to this position as well.
Okay. So you've navigated that. That's not something that maybe Mr. Wilmer can answer this for me, that we have to discuss in caucus related to a union issue?
Mr. Wilmer.
Through the Mayor, that's correct. Based on previous direction from Council in a general sense, this is something that staff can deal with through labor relations. Okay.
I guess just further to that, Mr. Wilmer, is there any other situations with the 900 series that we're dealing with this similar kind of inefficiency?
At this point, none come to mind, but certainly I think this will be the trigger for us to identify those and deal with it in a general sense so we don't have to keep on dealing with them as one-offs.
Yeah, I think that would be really crucial. I mean, it must be frustrating even for the staff person to have to sort of delay the process of being able to put in registrations. The maintenance items that you identified, do you feel that you were able to resolve that with your discussions, or does there need to be further discussions with FM and with...
We definitely need to involve the union. The discussions thus far have been with the staff of the market and the staff of FM to say that there is opportunity here. We need to articulate what specific items would be allowed and then get union discussion on that as well.
Okay, so would you be at liberty to talk about what kind of work that these staff would need to do or has to be included in their contract negotiations?
The examples that were given to me were general in nature, but there were things like troubleshooting what the problem is in the first place, minor repairs that don't involve plumbing or electrical, things like perhaps painting a door or fixing something that's come loose, things like that.
So generally what happens now is that if for example, a door needed to be painted or a doorknob had come off, the process would be it's identified, a work order is placed, the work order goes to FM, and FM slots it into their time.
I believe
sheets.
so. Cynthia?
How convenient that Cynthia's here today.
Ms. Fletcher?
Handy.
Through the chair. There's a couple of things that are playing into this particular situation, and one is we've had a lot of turnover at the market. So people with different skill sets have been coming in regularly. So I think one of the things we need to do is sit down and identify a body of work that could be handed over to the market staff, and it would be minor maintenance items. And then we have to identify that skill set and go after that skill set when we're seeking staff. So that is one of the issues. They did have somebody who was very handy at one point, could handle all of the minor maintenance. When they hired another person, they didn't come with the same skill set. So that's one of the other things we're working through with the market staff.
Okay. And the other thing I wanted to ask you, Karina, was you were talking about articulate the purpose and vision. So are you suggesting that council needs to sit and sort of have a brainstorming session about where we want our market to go, what we see the future of the market, and what we're interested in doing in terms of strategizing?
Yes, that is correct.
Okay.
I think staff need a little bit more direction right now. They feel like they're under the gun and that it's being expected that they make a profit, yet under their current operating model, that's just not possible.
Okay. All right. So is that something you would be organizing, or would that be somebody... Oh, Jeff has his hand up.
Mr. Wilbur.
That's something that that economic development staff and I would be bringing back to council, likely in a strategy session.
Okay. All right. And would we be able to do that before the election?
Not necessarily. I can't commit to time frames yet. As between Kim Fury, Rod McGeer, and myself, we haven't had this conversation.
Okay. I think it would be really crucial. I mean, we're probably coming into the busiest time for the market. You know, as produce starts coming and more people are. I mean, that's just not. That's one component of the market. I think that discussion would be really crucial. Your suggestion for a additional staff person, part-time staff person, have you discussed when something like that would be? I think I did read you were talking about when that would happen, but was that under...
There's no timelines attached in my report. I have spoken with Kim Fury, the manager of the market. They're still trying to determine how they're going to fund that, whether it's through additional current headcount. And there's a couple different options on the table that they're going to work through. I'm not sure where they're at in that process right now.
Okay. I'd be interested in the follow-up of that, just because I think that an additional staff person may be able to help generate some revenue, and that may offset the head count. Okay, thank you very much for this.
Councillor Ioannidis.
Through you, Mayor Zaire. Thanks, Karina, for your report. My question is along the lines with that part-time position, because it seems like a rather stressful environment to be working under right now in the market there, with everyone's not able to take any breaks. Has there been any thought, and depending on the part-time position, whether it's a really low-level administrative position, that maybe co-op students or summer students could do that position in the meantime, or you can have that as an additional resource to this position as well, so that staff can actually be more proactive and be less stressful?
That's not something that I had considered, but the comment about getting the Series 9000 staff able to do that, I mean, that is a part-time staff that's currently working there right now, so if we could allow her to do more things, then that would certainly help out in the meantime before they actually hire the position.
Okay. I think that's all my questions for now. Okay, thank you.
Councillor Glenn Graham.
Thanks, Karina. I'd like to ask, I don't know if this is beyond the scope, about security and whether or not there has been any consideration of what happens if there's an incident and someone's required to attend there. Did you look at security at all?
It was mentioned in terms of some of the issues that they're dealing with through the market, just in the context of what's taking away from the manager's time, but we didn't get into details.
Okay. I've also had a conversation about bylaw enforcement regarding parking along the streets, and I was wondering if that came up at all.
Again, not into detail, but it was another issue that was draining the time of the manager right now.
Right. And then I guess the last issue is regarding the bookings. What kind of bookings were these that were alluded to? Was it like weddings or private functions?
Yeah, private functions that would use the marketplace. So sometimes they use them for showers or for, group events, or I'm not sure exactly everything that it could include, but it's similar to what a community center would be rented out for.
And have you noticed a trend in corporate bookings now that the sound is improved in the upstairs?
They have, definitely, yes.
So you've noticed that that's the trend is favorable there.
Yes.
Have we optimized that, or is there still room there during the week?
I would have to get back to you on that. I'm not exactly sure.
That would be helpful.
So you're looking for the capacity?
The capacity and what percentage of capacity we're at during the week. Thanks for your hard work on this.
Councillor Yanetsky.
Yeah, thank you. The staff at the market, do they work a Monday to Friday shift, or is it really the full-time staff, or Tuesday to Saturday?
Tuesday to Saturday.
So Monday it's closed.
Yes.
No staff are there working behind the scenes or anything like that.
I would say that the manager and the program coordinator often work from home, even though they're not being paid on that day.
Okay. So in your analysis, you talked about overtime, unpaid overtime of 6.7 hours. Is that based on the full-time staff, or is that including the part-time staff combination? How's per day? How does that work out?
It included the 3 full-time staff. There are 4 full-time, but one of them was the custodian, and I didn't track his time. So it was the manager, the program development coordinator, and the program assistant. So the 3 of them combined, their overtime added up to 6.7 hours per day on average.
So that's based on a 35-hour work week?
Yes.
Okay, so if you're looking at 6.7 hours, you said per day per 3. So that works out to just over 2 hours per person per day per 5 days, which is a little more, but like about 11, 12 hours per week, which is like about a 42, 43, 45-hour work week.
Yeah. So my comment to them as well was that, with the management position, you tend to expect a little bit of unpaid overtime, but with the union positions, really we're in contravention of the collective agreement.
So of the full-time positions, the 4, how many are non-management? Non-union.
There's one that's non-union, which is the manager.
Okay, and the rest are all unionized. Okay.
Yes.
You mentioned about to reduce turnover. Is this turnover for full-time staff or the part-time staff?
The full-time is what I'm referring to.
Okay, so amongst those 4 people, they're coming in the door. It's like a revolving door there.
Yes. And a lot of it is due to the stress of the workload and not getting their breaks and being overwhelmed.
Well, talking about the workload issues here due to stress as you're identifying them, would that be the volume of work, or is it the variety of work that because new persons come in, they may not be skilled in certain components of it, and does that cause the stress and the workload issues? Or
overall,
because the market only operates on a Saturday with special events thrown in here or there.
Yeah, it is a full-time job throughout the week as well. There are a lot of administrative tasks that go into running the market. I would say overall that there is too much work for the positions that we have, but it also is exaggerated by the fact that when there's turnover, the existing staff have to pick up the slack, and then they have to train a new person, which, they're not as efficient at their job in the beginning. So those factors all play into it as well.
So when you're talking turnover, how many persons per year is that equate to?
I'd have to get the exact figures for you, but I know that the program assistant position, which is the one that I'm recommending another part-time version of it be created, that one has turned over at least usually once a year, at least, if not more.
And the other one's more or less about the same?
I think she said that she's going to get some information.
Okay.
Yeah, I can get back to you on that.
Okay, thank you, that's it.
Okay, I see no other questions, so let's move to cash deposits.
All right. All right, so I'll just start off with some statistics from the Association of Certified Fraud Examiners. They said on average, most companies will lose 7% of their revenues on an annual basis due to theft or fraud. And it goes on further to talk about employee theft as part of that. 75% of employees have stolen at least once from their employer, and 37.5% have stolen at least twice. So these statistics really highlight the fact that we need to have stringent controls, and we need to make sure that all of our controls around our assets are tight. So this audit really focuses on our cash, as this is one asset that is easily stolen. And the objective of the audit was really to document what our processes are from the time that we receive cash from the customer to the point where we put it into the deposit, and look for any of those control deficiencies. What I did was I interviewed the staff who collect the cash at 44 different locations across the city. And then I documented those processes and made recommendations wherever I found any control deficiencies. My initial take at this was I looked at the 44 locations and I divided them into high, medium, and low risk based on what I perceived the risk to be. So the high risk category were things that had a high volume of transactions, low dollars, where the customer wasn't necessarily expecting a receipt. So those are things that I thought there might be some potential for theft. The medium risk ones were ones that still had high total dollar volume of cash, but had a point of sale system or some other process in the background that would potentially limit that theft. And then the low risk ones were either ones that had very low dollar volume of cash transactions, or they're ones where I've done in-depth audits of them before. So for example, previously, if you remember, council had asked for audits of building and parking and I think revenue as well, to see if there was any opportunity for staff to be accepting cash in the field or to be siphoning off cash. So we've done reviews of those in the past, so they were not included in this audit. From that list, I then focused on the high and medium risk locations only, and only focused on cash. So we did not look at checks, debit, transfer, wire transfer, or credit cards. Once I went through the interview process and documented all of the processes, I then reassessed what the risk was based on what I found. So anything where I found some control weaknesses where it was possible to steal cash and the potential exposure was greater than $1,000 per year, they fell into high risk. And I calculated the exposure by taking the amount of cash revenue for that location multiplied by that 7% theft statistic. The medium risk category is anything where there is the potential for theft and the exposure is less than $1,000 per year. And then the low risk category is anything where the controls are tight and there is no opportunity, or there's such a very low exposure. So this chart just shows you a summary of those 44 locations. So my initial take of things, there was 27 in the high risk category, 5 in the medium, and 12 in the low risk category. Once I'd done my assessment, good news is we have a lot less in the high risk category. So that dropped down to 9, and 8 in the medium, and 27 in the low. The annual exposure, as I mentioned, was the 7% times their cash revenue, just specifically for the areas where there was potential for theft. So it totaled out to $25,000 over the years, our potential. So that's not saying that we are losing $25,000, it is just the potential. So what I did find was that most divisions do have adequate controls in place, which is a good news story. A lot of them do use point-of-sale systems, and that allows us to run a daily cash balance, which shows us the amount of sales for the day, which then translate into how much cash we should have on hand. The places that don't have point-of-sale, most of them have duplicate or triplicate receipt processes that are numbered and sequential so that we can track back to make sure that all the receipts have been used and are accounted for. And many of these processes also reconcile to other systems, so inventory lists, numbers of participants that have gone through the program so that we can track back and say, this is how much we should have in revenue. But as you saw on the chart, there are still 17 locations that are either high or medium risk. So these are locations where there is the potential for theft. And as I mentioned, the overall exposure is $25,000 per year. But on an individual location basis, the exposure is very small. So unless you knew how to work every single location, you probably would not be stealing a lot of money. So my recommendations, I've actually provided a quite lengthy document to the management of these locations with recommendations on how they can fix these control weaknesses. And where it makes sense to do it, I'm recommending that they do implement those recommendations. It may be a situation where it costs more to implement the fix than it does than that we have exposure for. So in that case, it may not make sense to fix it. I'm also recommending that I come back in another 3 to 5 years to make sure that the controls are still in place, and if there's any new revenue streams, that we have a process in place for those as well. So are there any questions on that audit?
Just a few. Councillor Ioannidis.
Through you, Mayor Zier. Karina, the question that I have is relating to, I guess, you answered my question that I wanted to ask was about the locations. Are those locations primarily like community centers?
Community centers, pools, and arenas are kind of where the risk areas are.
You did mention about concerns about receiving some cash without receipts. What situations where would that occur?
I don't want to say in open session only because it opens us up to where our vulnerabilities are, but it would be a situation where it would be low dollars where the customer may not need a receipt for any purpose.
Okay. Thank you.
Councillor Glenn Graham.
Thanks a lot, Karina. I guess I'd just like to know about the, whether there's any leakage that's been measured in terms of cash. Is there any anecdotal evidence or any measurable way to know if we are losing money?
Yeah. Anecdotally, I did ask that question in my interviews to say, have you had any concerns? Are you, anything that you've noticed? And nobody mentioned anything. The types of control weaknesses that I found, it would be impossible to find that unless you were literally viewing the person stealing the money.
Right.
So
I guess that begs the question, do we have any way to know if there's like a reconciliation like a bank does? Do they tally it up in any way during the day or week? Do they have a sense of whether things are matching up?
yes, in the places that do have solid controls, that's exactly what happens. They have the daily cash report that comes out of the point of sale system. It tallies, it shows you how much checks, debit, cash. They then reconcile that report and print it off and put it with the deposit. On the accounting division side, they are reconciling the bank deposit to make sure that what we have in our deposit system matches what the bank actually received. There's also secondary controls for things like for example, in some of the pools, the lifeguards will have a tally of the number of patrons that came in, and they'll reconcile that back to the point of sale system to say, well, we should have had this many admissions come through today. So things like that.
So on the 17 weaker areas or the ones more at risk, there's no kind of reconciliation is what you're saying?
Correct.
Okay.
So I've made recommendations, and for a lot of them, there are other locations that do have the proper controls in place. So it's just a matter of doing what other locations are doing currently.
It would just be interesting to know as an appendix, or if you could follow up with us, what those recommendations are. I'd be very interested to know. So if you could share those, that would be great.
It would need to be in a confidential report because I don't want to expose our weaknesses to the public.
Okay. That's fine. If we could do it in caucus or something. Thanks.
Councillor Etherington.
Yeah, Karina, through you, Mr. Mayor. Those stats from the Association of Certified Fraud Examiners, they seem fairly high. I don't want you to give me any details, but did you find any examples of cash theft?
No, like I said, the areas where we have control weaknesses, unless I was there physically watching someone take cash, I would never be able to find it. It's not something that you can test for or that you can do a reconciliation to say that the money's missing.
And when when these kind of suggestions are present, is there anything you're coming back to us in confidence to tell us about?
If I came across any theft, then definitely I would bring it into caucus to tell you about it.
But you didn't?
No.
Thank you.
Okay, no further questions on that as well. So we'll move to item number 3, which is the risk management update. The slides are still labeled item 2, but the report is item 3.
It's still on there. Just give me a moment here.
There we go.
There we go.
Go ahead, Karina.
All right. So this presentation is just to give you an update on where we've come from with risk management and where we're going in the future. And it's really back to that audit committee responsibility that's in your terms of reference. It says that one of your responsibilities is to ensure that management has established and is maintaining a comprehensive risk framework. So this presentation is just to give you assurance that that is happening. So just to give you the definition of risk management, really it's the methodologies that we use to proactively manage our risks and seize opportunities. And we have a number of different ways that we can treat risk, and that is by accepting risk. So there may be situations, for example, like I mentioned in the cash deposits, where it is more costly to fix the risk than it is to just accept that it could happen. Transferring the risk is, for example, using insurance, transferring the risk to a third party. Mitigating risk, so putting in different activities that would help reduce the impact of the risk, or eliminating the risk altogether. So our journey with risk management really started back in 2008, and we had 2 large projects on the go at the time. There was the Delta project, so that was the installation of CityWorks, SAP, and Riva, as well as the CMF project, or the COF. And at that time, we hired a third-party advisor to come in and help us put together a risk assessment at the start of the project to say, what are all the possible things that could go wrong, so that we can put some mitigating actions in place to make sure that we have project success. And throughout that whole process, internal staff were trained on how to do a risk assessment, how to put a policy in place, what the terminology was, so that we could go forward without the need to have a third-party advisor. Today, we are using that framework in a number of spots. We've had several large projects since that time period where we've done formal risk assessments and we've monitored the risks throughout the projects, as well as a few divisions that have done it as well. When the violence in the workplace legislation came into effect, one of the requirements was for us to analyze our risk in this regard. So we used the corporate framework and methodology for that. 2 years ago, when we put together the service review and internal audit work plan, we also analyzed the risk across all divisions using that same framework. And we've also used it more recently in our business continuity efforts in order to help identify what our most urgent business processes are. So it is getting a wide use across a number of different disciplines across the corporation. So moving forward, there's really 3 areas that we want to focus on, and it's really with an intent of embedding risk management even further into our culture, so that it's not just a handful of people that know what it is and how to use it, but that everyone can use it as a tool to manage their business. So the 3 areas are governance, process and tools, and staff training and experience. So under governance, we've already have a risk management policy in place that was approved by council. And so that's a good starting point, which really lays out what our risk tolerance is, what our framework is, what is the common terminology that we're going to use. Going a step further then is to really make us accountable for having risk management in place. And that comes in the form of me coming back to you on an annual basis to give you a report similar to this, just to let you know what's going on in the corporation regarding risk management. On the process and tools level, I've created a number of templates and instructions that can be provided to project managers. And that's something that's going to be worked into an upcoming project management course that will be offered across the corporation. We've also trained departmental reps on how to do a risk assessment, so that as we go through and do comprehensive audits or reviews, service reviews, that will be one standard component of all of them going forward. And out of this, we're going to create a risk library. So this will be a collection of all the divisional risk assessments so that senior management will have a view for what are all of the risks that are affecting us across the corporation. Are there things that are common across all divisions that should maybe have a corporate response to them? And then finally, including it somehow in business planning. So when we look at business planning, we're looking at, what are the goals of each division? What are we trying to accomplish? The risk side of it is then, what are the things that could stop us from achieving our goals in the business plan? So we still have yet to work that out in terms of whether it's actually included in the business plan document or whether it's just some planning that goes on in the background. But I think it's a very important piece that will help us better achieve our goals. And then finally, there's the staff training and experience. So I'm creating a course right now called Risky Business, which will be offered through the capacity course. And it's going to be tied to the project management course as well. So anyone that takes that course will be encouraged to take this add-on as well, but it will be open to everyone across the corporation. And that course will focus on what the policy is, what the terminology is, how to do a risk assessment, and why it's a benefit to you, so that people can use this as part of their toolkit. And then finally, the participation. So as people go through a comprehensive review or audit, they're going to be part of the workshop. They're going to learn about risk management through that process. Or if they're on a large project, they also will be involved in doing a project level risk assessment. So as more and more people get involved, the knowledge is going to spread across the corporation. So just in conclusion, this is just, risk management has been a focus and will continue to be a focus going forward. We've already laid the groundwork with the policy and some of the templates and things that we've been using, and the future work will then focus on just drilling that down to more staff across the city. All right, any questions on that?
Councilor Fernandez.
Thank you. When you're talking about risk, and so I'm looking at your processes and tools on page 3-3, can you give me some concrete, or give us rather some concrete examples of when you're talking about risk? I mean, I think when it comes to mind, risk would be, sometimes risk is just getting in your car and driving down the 401. That's a risk every single day. But are there some clear risk identifiers that you could explain to us?
When I talk about the templates, there are some standard templates that I've put together that have common risks. So common risks to projects, common risks to road projects in particular. And those come from Infrastructure Ontario. So they're things that most projects would come in contact with. Divisional level risk assessments, that's more, I wouldn't say that there's a standard for that, but that comes out of the interviews that I have with the staff. So what are the things that could impact your business and impact you from not being able to achieve your goals? And it could range from things like, we've got 5 people retiring, that our risk is that we're going to lose all this knowledge, or it could be risk of injury because we have a very high risk, for example, in the odd and arenas, one of the risks is injuries of people doing skating. So it varies depending on which division you're in and what project you're working on.
So do you look at the history of risks that first, maybe I better preamble this. Some risks result in us being embroiled in litigation, so a trip and fall kind of thing. Those kind of issues, I guess, are what I always think of as risks right off the bat. I know that there are a wide variety of other risks, and you've just identified a couple. So do you, or have you looked at the history of risks in different areas of the city and seen how many times that those particular risks have occurred?
Not yet. We're not that mature yet. We don't have a complete risk library to see what the risks are in each division at this point. A very narrow focus, you mentioned the trip and falls and things, and those types of risks are tracked by our insurance pool, so they do the analysis on those types of risks. But the more broad category of risk, we don't have that comprehensive view at this point.
Okay, so that's what you mean by a risk library. So
yes.
that you would be taking the history and then plugging that in. Do we still have that independent advisor? Or was that
No,
just
it was
for
just
that?
for the 2 projects, and we learned from that, and we're able to do it on our own now. So.
Okay. The wording that you used in moving forward on page 3-2, and you said it's critical that the city work to embed risk management into the culture. Critical is a pretty strong word. Why would you say that it's critical as opposed to important? I mean, this may be semantics in a way, but I do get the sense that more and more municipalities are looking at risk, and I wonder sometimes if it hampers us from moving forward on particular projects or particular issues because we're so wrapped up in worrying about risk.
I would argue the other way in that I think that by looking at risk in the proper light, you can identify opportunities that you may have missed otherwise. You can also identify things that could really hamper you if you have to react to them as opposed to proactively addressing them. So from that point of view, I think if we want to be even more successful than we already are, I think it is critical. I think that we need to have that mindset of risk management, and that people need to have the tools across the corporation so that they know what we're talking about when we talk about risk.
Okay. And you're saying that you've set aside a course to help train staff to identify risks and possibly just try to create framework and benefits and techniques. How long do you think this will take to lay this out or to bring this forward to staff? I mean, we've got...
It'll be a half-day course.
Okay. No, but in terms of are you hoping to get to every staff person or a certain level of staff? Or
initially, it's going to be targeted at hand-picked staff that go on the project management course. So we have the first session will be 25 staff. From there on in, it will be targeted to, I guess, suggested in the catalog that it would be of interest to project managers and management in general. I mean, certainly anyone can take it, but I think those are the key groups of people that would benefit from it.
Okay, all right, thank you.
Okay, there are no more, there are no other speakers. So thank you, Karina, for all the reports today. Well done.
Thanks.
Mr. Chapman, can you speak to the audit services request? This is the information item.
Through you, Mayor Zaire.
Update.
One of the responsibilities of Audit Committee is to approve the appointment of auditors. You may be aware that under the Municipal Act, we can appoint an auditor for a 5-year term. KPMG has now concluded their 5-year term. So in anticipation of that, we issued a request for proposals, invited responses from firms, and pulled together a selection committee that, in accordance with past practice, included Mayor Zaire as chair of the Audit Committee and Councillor Davey as chair of Finance and Corporate Services Committee. I can advise that we had shortlisted the firms that responded to 2. We've conducted interviews with those 2 firms and are in the process of forming a recommendation for the selected firm. Typically, that would come back to Audit Committee, but because of the nomination deadline and the fall schedule, this report outlines that recommendation will come to you at your next Finance Committee after the summer recess.
Okay. There being no further business, this Audit Committee meeting is adjourned. But we will go immediately back into the caucus room to finish the one last item.